Namaskar and a very good evening everyone joined with us in this virtual webinar series with today's webinar on financial market outlook and alternate investment fund in India framework organized by Committee on Financial Market and Investor Protection of ICI. I should be Jain, member of Gwalior branch of CIRC of ICI, a practicing chartered accountant, having my core practice in corporate advisory. I extend a very hearty and warm welcome to each one of you present with us, and thank you all for sparing your precious time. I'm here with you for giving the opening remarks and will accompany you throughout the session as moderator. It is my humble opportunity and also a privilege to deliver this opening remark of this wonderful session on financial market outlook and alternate investment fund in India. And for this, I extend my gratitude to the organizers, the Financial Market and Investor Protection Committee of ICI, Chairman Shri Charanjot Singh Nanda sir, Vice Chairman Shri Kota Srinivas ji, especially with Nanda sir's support and blessings. I've been part of earlier webinars also, organized by Internal Audit Standard Board, where Nanda sir was chairman. So thank you so much, sir. As we all know, if we particularly talk about after COVID pandemic consequences, there is revolutionary increase in demat account holders in the country, and moreover, the broad classification is somewhere equal among investor as well as market traders. And if we are talking about investors, then the sense of investor protection must be upfront. And that is what exactly the purpose of foundation of this dynamic committee with very crystal clear goals, as committee is excellently working and each single step is achieving new heights for betterment of profession and society. And we are fortunate to be a part of this esteemed profession. So without taking much of time, today, due to some reasons, as Charanjot Singh Nanda sir is in Pakistan right now, and we are not able to connect with him at this moment. So he will join with us in between the session. And Charanjot Singh Nanda sir, a very well-known name, not only in CA fraternity and not only in India, but outside India as well. Person who is full of enthusiasm and passion, continuously contributing his precious time with great far-sightedness for betterment of members, this dynamic profession, and to whole society as well. Very helping and humble, words are not actually enough to define his personality. The one C.H. Charanjot Singh, Central Council member, ICI, Chairman of Committee on Financial Market and Investor Protection, Digital Accounting and Assurance Board, Chairman of Committee on Information Technology of SAFA, that is South Asian Federation of Accountants, Vice Chairman of Board of Internal Audit and Management Accountant, ICI. He was the member Quality Review Board set up by the Government of India. He has chaired many of the committees, including Internal Audit, Women Members Empowerment Committee of ICI, Professional Development Committee, Public Relations Committee, Committee for Members in Industry, Committee for Cooperative and NPO sectors, and many more. Member of SEBI Advisory Committee on Primary Markets and Mutual Funds. He has represented ICI on SEBI Committee on Disclosure and Accounting Standards, convener of the expert group constituted by the Ministry of Corporate Affairs, Government of India. He has served ICI since several years at various designations across different domains at regional as well as at country level. So now let's move forward for today's first technical session, financial market outlook. And for this, I would like to introduce our eminent speaker, C. Amit Chandakji. He has specialization in the field of direct taxes, audit and investment planning and consultancy. He is practicing the internal and concurrent audit of banks, educational institutes, hospitals, manufacturing industries, financial market intermediaries, cooperative societies, educational institutes, and IT firms. He is regular content writer and contributor to the world's largest viewed investment portal, investing.com, since last 4 years. He used to publish his views on Indian stock market as well as useful investment insights on the said portal. He has conducted various seminars and webinars with renowned stockbrokers in India and expressed his views and outlook on the financial market. He is actively engaged in social activities and has designated on various positions in various business associations. Now I request Amit ji to share his valuable wisdom with all of us. Over to you, Amit.
Thank you, Survi. Uh, Very good evening to everyone. I welcome you all to our virtual webinar on financial market outlook and alternative investment funds in India framework. I'm thankful to CA Charanjot Singh Nandaji and as well as Committee on Financial Markets and Investor Protections (ICI) for according me an opportunity to interact with you all on the very hot topic of the financial world, that is financial market outlook. So basically, generally market runs on sentiment, and everyone is asked what are you feeling about the market? Market क्या लगता है? So क्या लगता है is nothing but it's a sentiment, which is generally happening in the minds of our investors. And definitely, being a financial profession, being a financial professional as well as investment consultant, we chartered accountants are need to have a good outlook about the market, maybe for our self investment or to advise our clients on their investment needs. So let's start with our presentation. So first of all, let's start with market outlook. Right now, since last 3 months, means since October or November end, we have seen a good correction in market. Right from reaching the life high, both our indices have reached the life high of you can say uh, both Nifty and Sensex reached the life high, and thereafter both the indices have been corrected 10 to 12%. This is not only situation in India; this is a situation across the globe. Our all global markets, may it be the European market, may it be US markets, or may it be Asian or other markets, all have been corrected almost 10 to 12% from their recent highs. Now, what is uh, what the things which are impacting here are we have to look those we have to consider those factors. So markets are highly volatile due to geopolitical events. The military operations are going in Russia, various sanctions, thereafter inflation, the resulting inflation, as well as slowdown of the economic growth in various economies. This is the this is the these are the reason which have been adversely affecting the market sentiments. How these are affecting? There is a bank. Recently, we have seen the banking crisis in US. The Silicon Valley Bank has been now regulated, and now it has filed for the bankruptcy over there. There are already tensions like the geopolitical events. We are talking about the tensions between Russia and Ukraine, between Japan and China, between China and Taiwan. Thereafter, when we talk about the inflation, the US inflation is already at 40-year high, and slowdown of economic growth is nothing but we can say various developing markets have been affected by the military operation in Russia, military operation by Russia in Ukraine, and China, the one of the deflation exporter to the world, has registered the slowest growth rate this time. So these geopolitical events have been affecting in the have been affecting all over the markets, all the markets of our across the globe. But whether this correction is ending here or the market will correct more, this is the question always striking to our mind, and that's why I will likely to I will like to rely on some macroeconomic factors rather than news items. So basically, what is the present situation we can see in our news headlines. We can see in various social media that if market reaches, let's say Nifty reaches the level of 17,000, it may reach 16,000, it may reach 15,000, it may reach 12,000. So people are expecting the correction of 40%, 30%. Likewise, like what we have seen in 2020, March 2020, at the time of COVID. So March 2020, the COVID time was a, we can say that was a different time, and right now we are living into different time. So a normal correction of 10% is already we have seen, and for that various reasons we have we also considered. But whether the market is that this bear market, we can say correction, but people are calling it bear market. So whether this bear market will end here or any bull market is taking shape underneath, that we have to consider. And that's why I will I like to discuss on some macroeconomic factor. So these macroeconomic factors may be related to globe, or mostly macroeconomic factor related to India. I would like to discuss those factors. I would like to consider those factors before going ahead. Okay. So first factor we are considering here is CPI and GDP. So CPI, that is Consumer Price Index, and GDP. These two factors definitely, being a financial consultant, for us, inflation rates and interest rates are two most important factors, and that needs to be considered before taking any financial or investment decision. So right now, quarterly projections of CPI is before you. At this point of time, we are living with the inflation index of 6.5%, where inflation in the rate of inflation is 6.5%, and similarly our GDP is also projected around 6.5% this time. What RBI is expecting is RBI expecting that the CPI for the first year, that is the inflation rate for the first quarter of 2023-24, will be around 6.8%. Thereafter, for the second quarter, it will be 7.2%. Thereafter, for the third quarter, it will be 6.2%, and for the fourth quarter, it will be 5.8%. So RBI is expecting that inflation will be top out by second quarter with the rate of inflation rate of 7.2%, and that's why thereafter it may likely to dip below 6 point 6 percent, that is 5.8%. So that inflation is there, but it likely to ease in the second quarter. Now, what are the factors which likely to ease the inflation here? First is crude oil and global commodity prices. So when Russia and Ukraine war was there, or when the Russian military operation started in Ukraine, we have seen that crude prices see the level of $130. But right now, the same is been eased to below $70. Okay, from 130 to 70, that is a good easing in crude oil prices, and that's why the inflation is likely to go on the lower side. Second one is the monsoon. The Indian Meteorological Department has projected a good monsoon this year, and good monsoon will definitely result in good crop output, and that's why if good crop output is there, the supply of food items will be at the cheaper rate, and that's why I'm expecting CPI, that is Consumer Price Index, likely to be slower. So reduction in crude oil prices as well as reduction in crop prices, that is food inflation, will have good impact on easing of the CPI here. And once CPI is reduced over here, and good crop output as well as good industrial output will boost our GDP in positive way. So GDP projections at higher side and CPI inflation at lower side is a good sign for economy. Though we are living in the bull market, see the positive side which are likely in the upcoming period, and these projections are for up to quarter 4 of 2023-24, and that's why if we are seeing that the inflation will be reducing by 2024 March, and the growth rate of the GDP rate is likely to increase up to the fourth quarter of March, then definitely there is a bull market taking shape underneath somewhere this bear market. Then let's have a look at GDP projections by IMF. So GDP growth of the various countries, that is advanced economies and emerging market economies, has been projected by International Monetary Fund, and these are the recent numbers. I'm seeing here the January 2023 reading. For January 2023, IMF has projected the world likely to see the GDP growth increase from 2.9% to 3.1%. For emerging market for advanced economies, I'm not seeing very higher growth rates. But yes, when we talk about emerging market economies, so here you can see that India having a sweet spot as far as GDP growth projections are considered. For China, GDP growth projection is considered from 5.2 to 4.5. So China likely to see reduction in GDP growth rate, whereas for India, there is a growth rate of 6.1% to 6.8%. So whatever market situation is there, market has been taking some downward correction in the current phase. But the projections given by IMF based on certain statistics, and those statistics are showing that India likely to grow at the rate of 6.8%, which is highest among every nation across the globe. And this is the good part, and this is the latest reading. It is a reading of January 2023. So the latest reading is showing that India will grow at the rate of 6.8% in 2024, and I find it's a good reading, and one should bet on this reading and bet on India. Before going further, one more economic factor I would like to discuss here. We are discussing various global economic, global as well as domestic economic factors, basically a macroeconomic factors, in order to assess whether there is a bull market taking place under this bear market or not. So let's have a look at global commodity prices as well as food prices. So global commodity index is right now reduced from 130 to 100 and odd levels. So almost more than 25% reduction has been seen in the global economic price, global commodity prices. But this definitely after March 2022, or we can say May 2022, we are seeing the softening of the global commodity prices. When we talk about Brent, look here, the Brent is there, and I find the Brent prices in the month of February 2022, when Russian military operation started in Ukraine, it has been reached around 130 odd levels, and right now it has been softened to below 70 $80. Brent prices are now right now below $80, and we are expecting it to fall further. The futures are likely to fall further. Therefore, softening in the Brent prices will also be there. Similarly, food prices, due to Russian military operations, the supply of fertilizers and food items was halted, and therefore food prices was they're at very highest level. But right now these are softening again. These are expected to soften because of the good monsoon and good food output. Metal prices, yes, metal prices are worth considering here. Since July or August 2022, we have seen that the metal prices are increasing. So these kind of metal prices, basically steel, copper, and nickel, these metal prices are increasing, and these are the industrial metals. So industrial metal, the increasing industrial metal shows that there is a good economic activity is going on in the heavy industries. So हेवी इंडस्ट्रीज में जब मेटल की प्राइसेस, कॉपर की प्राइसेस, स्टील की प्राइसेस बढ़ती है, तो कहीं ना कहीं एक इकोनॉमिक रिवाइवल जो हम बोलते हैं, वी शेप रिकवरी इज टेकिंग प्लेस इनटू इकोनॉमी, एंड दैट इज सजेस्टेड बाय द मेटल प्राइसेस. सो all in all, reducing inflation and good demand for metal, these are the two factors I find these are good for economy as such. Then, yes, one more thing, inflation. Let's this is the most important factor when we talk about investments. There are two factors needs to be considered. One is interest rate and another is inflation rate. So inflation across the globe is definitely was increasing, and there was a situation of stagflation into advanced economies. So rate of growth in inflation uh, is much higher. If you consider advanced economies, their central banks have targeted the inflation rate of 2%, and right now the UK inflation is around 10%, US inflation is around 4.5%, Eurozone inflation is around 8%, and Japanese inflation is around 4%. So uh, every advanced economy is not adhering to their central bank target, and there is a situation hyperinflation in those economies. But when we consider it with emerging market economies, so in emerging market economies we are finding that except Russia, all other emerging markets are having optimum number of inflation, which is likely to be slower down. From March 22 to December 22, we have seen the reduction in inflation in India. So it's a good situation, and again we have seen that the softening of crude prices, softening of food prices will have good positive impact on the inflation numbers in India, and it's likely to be eased in the upcoming sessions. Now, what is the effect of inflation and supply? So basically, people are considering that inflation is bad for bull market, and that's why bear market is always there. But believe me, it's a myth, and we need to bust it. Inflation numbers or inflation is never harmful for bull market. Inflation is always a factor which creates the bull market, and it is very important factor for the longer term bull market. Let me give you a most ideal equation for this. Always keep in mind that optimum interest rate and optimum inflation rate and good GDP growth rate, these three factors combine or jointly create a great bull market. So optimum interest rate is one of the factors which we can see in RBI policy. Optimum inflation rate, once the inflation is starting easing out and it reach to the optimum level and supported by good GDP growth, definitely we will be seeing a great bull market in India. However, when we talk about the commodity bull market never starts or with increasing demand. It always starts and remain over there with the supply disruptions. So whenever there is supply disruption, the bull market for that commodity starts. So we can see that supply disruption was there at the time of Russia-Ukraine tensions, at the time of COVID. There was supply disruption, and that's why we have seen the commodity prices were hitting the new high. Basically, base metals were hitting the new high. Where agriculture commodities were hitting the new high. The bull market was started with supply disruption. It never started with the increase in demand. Okay. Now, global financial markets. Let's have a look over there. When MSCI indices are definitely have seen some bottom in October 2022, and thereafter since till now we are above those levels. In the US bond yields, we have seen that in last 1 year it has been doubled. So it is having it is showing the impact of inflation over here. But when we talk about the currency indices, yes, dollar index has been seeing the level of 115 some days ago, and thereafter it has been reached to 103 level, whereas emerging market currencies were at 85 odd index level, and now it has been reached to 105. So softening of dollar is the important factor which likely to have good impact on the emerging market. This is the most important indicator which one need to understand here. Okay. Thereafter, portfolio flows to emerging market. Yes, in March 2022, we have seen large number of selling by FIs, and thereafter, yes, smaller or medium size of selling is coming throughout the year. But since November 2022, we are seeing the investments made by FIs in the emerging markets are very good. People are always confusing the FIs selling with the bear market. So many times people ask me, yeah, sir, already they have invested so much amount in from 2004 to 2008, and almost that much amount they have been taken out from the Indian market. Then how much amount is left with the FIS for the further selling? So rather than going for that analysis, let's have a look at the sectoral analysis. How much investments are made by FIs in their equity portfolios for automobile and auto component. On February 2023, their total investment was valued at 2,71,579 crores, which have now been reduced to 2,61,143 crores. Their highest exposure was seen at financial services sector, that is including banks, insurance, and financial NBFCs. Amount of 15,51,000 crores was as on 15th February 2023. However, on 20th of February, the AUM, that is the value of those shares, was 14 lakhs 94,557. So even on February 28th, if you want to see how much amount of the shares held by FII. So just see this last column, the bottom last column. It shows that FIIs are now having total amount of 44 lakhs 21,059 lakh crores. 44 lakh crores. This is the number of shares held by FIIs in India. So if one is seeing that FIIs now selling extravagantly and they will leave India, it is not possible, because the quantum of amount invested by them or quantum of amount of the market capitalization held by them is 44 lakhs crore, and definitely this investment will grow along with the bull market in India. So once this number are seen, I am confident that the selling, that is kind of profit booking, may be undertaken by FIS, but definitely this whole amount will not be sold by them. These investments will get manifold in upcoming years, and that's why I find that even along with the FI holdings in India, I find there is a bull market intact in India. Smaller correction will be there. Along with FI, let's have a look at FDI statistics. Till 17th March 2023, the FDI business requests were counted at 3,43,218 numbers. So 3,43,218 requests have been received in India till yesterday, 17th March 2023, and these requests are having business in pipeline, that is investment in pipeline of 202.24 billion dollars. It is a huge number in rupees terms. Okay, now when we look at the sectoral aspects, that the amount coming into India, whatever the business requests are coming into India, if we have their sectoral analysis, you will find that most of the amount is coming toward metal, mining, and mineral section. And secondly, mostly second most sector is which is fetching the investment from FDI is oil and gas exploration. So I bet for because being the heavy industries, metal mining and minerals are the heavy industries. Oil and gas exploration is also one of the most heavy capital intensive sector, and that's why their results cannot be visible on in a day or two or in a month or two. It will be needed almost 10 to 15 years to realize this investment in many folds. So I find these two sectors are the unbeatable sector, and one can bet on this sector for the 15 years onwards. after 15 years, these two sectors, you will find that these two sectors will be beating all other sectors in the term of returns on investments. Now, let's have a look at changes in policy rates adopted by various central banks across the globe. Okay, in advanced economies, we have seen that from the every country have adopted the change in their economic and in their interest rate, and most of them have make changes from 2.5% to 4.5%. But when we have a look at emerging market economies, specifically in India, our interest rates have been increased by only 2.5%, which is much more lower than advanced economies. That's why I'm saying that India is very sweet spot as far as optimum interest rate, optimum inflation rate, and good GDP growth rate is concerned. And if these three factors are there, then there will be a good bull market, at least for India. Secondly, the projection of IMF, as we have seen, growth rate of 6.1% to 6.8% in 2024, it's also a boosting factor. Now, one more economic factor which I would like to add here is e-way bills and toll collections. So just look at the e-way bills. Okay, in January 2022, there were only 70 million units of the e-way bills were generated, which is right now we are around 90 millions. So what is this showing? This showing that there is a consistent increase in the business. There is consistent increase in the business, and which is reflected through the e-way bills and toll collections. Now, e-way bill and toll collection are basically the important factor which are showing the changes or increase in the logistic or transportation activities. But definitely, e-way bills are not related to passenger vehicles. The movement of passengers, it is related to movement of goods. That's why considering the toll collection and e-way bill jointly will give you good insight about the logistic and transportation activities taking place in India. And if we consider these both jointly, toll collection and e-way bills, then we can find that the increase in the number of transportation activities, logistic activities in India are taking place on a good shape. So why there is an increase in transportation? Definitely there is a business revival. There is the business quantum, business activities are been increasing. GDP growth is increasing. That's why there is an increase in e-way bill and toll collection and logistic activities. Okay, so these two factors don't give you amount wise consideration how much GDP is going to contribute, but we can shape up, we can have a conclusion about the shape of recovery taking place, whether it is recovery taking place or not. We can consider from these two factors. So increase in e-way bills, increase in toll collections, somewhere shows increasing logistic transportation activities of the commercial products. And when commercial logistic transportation is taking place or it is increasing, it's underneath indication that our business activities are increasing, and definitely if business activities are increasing, it will have positive impact on the GDP. Let's have a look at automobile sector. For automobile sector, yes, petroleum consumption is one of the most important factor which is shown here. Automobile sales, yes, since November 2021 to September 2022, we have seen good number of automobile sales. However, in after September and October 2022, when festival seasons have ended, we have seen the downfall in the automobile sales. But since January 2023, it started again increasing. So this trend likely to go ahead, and we can see good automobile sales in the upcoming years. Vehicle registration, obviously, it is correlated with the automobile registration and having similar chart. That's why then if there will be increase in automobile sales, we will see the increase in vehicle registrations in India also. But when we look at the automobile demand from the rural sector, we can see that two-wheeler and motorcycle sales are taking shaping up in a good side. Moreover, one more important factor here which we need to consider is tractor sales. So tractor sales, cargoes, and transportation, these are the commercial vehicles which are having good demand in the upcoming years, which is showing that economic is somewhere reviving. Again, next sector is hotel sector indicators. Let's have a look at hotel sector indicators. So most important factor is occupancy rate. In June 2022, the occupancy rate was around 20%. Obviously, there was a second wave of COVID at that time. So April, May, and June, due to second wave of COVID, various restrictions and lockdowns were there, and due to these restrictions, occupancy rates were not so good at that time. But after June 2021, we have seen a good recovery in occupancy rates, and now hotels are seeing the occupancy rates around 70%. So when we see that 70% hotels, the occupancy rate of hotels is 70%, obviously this occupancy rate have consequential increase in the revenue of hotels, and we can see that average room rate is also increasing from 60 to 100%. That is, if we consider the index, there was 40% reduction was in average room rate. Right now, there is a increase of 20% in average room rent, and definitely occupancy rates increase and room rate increase have the positive impact on the revenue of the hotel industry. Now, why these factors are needs to be considered here for the stock market analysis? Because hotel industry, the hotel sector indicators are nothing but good. What you can say? These numbers are of tourism. These two numbers reflect the tourism activities in India, and right now, you believe it or not, the tourism is also becoming a good source of GDP. That's why the passenger movements, secondly, hotel occupancies mostly are due to business occupancies, and that's why business growth is also being reflected over there. So tourism as well as business growth both can be assessed from these hotel sectors, and that's why that is the most important sector, most important indicator we are considering here. So increase in that hotel occupancy rates is a good indication here. Now let's have look at the trends in exports. Okay, so after May 2022, we are seeing the gradual reduction in exports. Definitely, this is not a good factor. But when we talk about, when we have to look at why these exports are being reduced. So basically, a recessionary situation across the globe is the main culprit which is hitting the exports. Maybe exports of China, maybe exports of India, but global recessionary situation. Though none of the central bank is accepting that there is a recession, but always keep in mind when you are seeing that stock market are crashing, there is crude is crashing, bullion is rising, and bond yields are crashing. These four factors somewhere indicates that there is a recessionary situation. Whether it is confirmed by the central banks across the globe or not, any particular central bank of any country is not accepting that there is a recession. But these four factors, being a student of economics, you have to consider these four factors, and you can simply assess whether there is a recessionary situation or not. And right now, when we see these four factors into combination, we can see that yes, there is a recessionary situation, and that's why exports are diminishing here. Similarly, when we talk about trends in India for imports, so here again, after June 2022, we are seeing there is a reduction in import. Now, this may not be reduction in import due to numbers, but this is the reduction in import due to fall in dollar index as well as fall in crude prices. So what you have seen here, just have a look at January 2023 candle. Yes, the fuel import, that is petroleum, oil and lubricant import, has been reduced so far. The gold import is very low at this point of time, whereas non-fuel and non-gold import, that is normal merchandise import, is at the same space. So our basic, that our most of the capital account deficits comes from the crude import as well as gold import, and reduction in the crude oil prices and reduction in crude imports will have the positive impact on the current account financial the current account deficit of India, and that's why this is the most important trend one should not miss. Yes, monthly revenue GST. This is the most important factor we need to consider while assessing our economic situation. And you can see that, okay, in April 2020, due to COVID, there was no GST collection. But pre-COVID levels are around 100 and around 120 crores, which are now surpassed above 150 crores right now. And if you see, since June 2021, we have the gradual increase in our GST revenue. So this GST revenue will not give you exact picture how economic shaping up, but yes, a broader idea can be taken place that if there is increase in GST revenue, we can simply conclude that the GST revenue is nothing, is increasing in line with the increase in businesses. So increasing businesses will always be can always be assessed from the increase in GST revenue. So this is most important factor, and as we have considered that GST revenue is now indicating somewhere that businesses in India are flourishing, businesses in India are increasing, businesses in India are growing at a rapid pace. Okay, so though there is a correction in stock market, but underneath the economy is getting strong. Again, as we have considered toll and freight correction, so toll and EV bill statistics right now. On the similar line, we have to consider rail and port traffic also. So if you have a look at rail and port traffic, you can simply find here that iron ore from July 2022 to right now, it has been increased at a higher space. Secondly, iron ore by the cargo is also getting shipped. That's why I told you that metal mining, so transportation of iron ore taking place through rail and port, that quantum has been increased. Secondly, FDI number increase in your FDI coming into metal sector is one of the highest FDI. And thirdly, the increase in metal prices, as we have seen in the earlier slides, is indicating that metal sector is somewhere flourishing. So one of the important sector, metal sector, is you should keep in your portfolio right now. That is the decision. That is can be an advice we can give here. Now have a look at steel consumption and cement production. These blue bars are showing you the steel consumption, and the orange bars are showing you the cement production. So when you have looking cement production, so it is increasing. So it is increasing from July 2022 to December 2022. Definitely, without demand, the production never increases. So this is the important factor we need to consider along with the steel consumption. Now, steel consumption since July 2022, we are seeing gradual increase in the steel consumption till January 2023. Even latest statistics may come with some higher numbers for the February and March also. In combination, these are not to be seen separately, but when we see the steel consumption and cement production in combination, we can see that there is a huge market. Wait a moment.
Roji, Amitji,
Yes, sir. Yes, ma'am.
sorry for interruption. Just to convey one thing, actually, your screen sharing is not correct. I guess slides are not moving on screen.
Slides are not, you are not able to see slides.
No, no, sir. Only the cover page is visible. Yeah, now it's changed.
It's okay.
Yeah, it's fine now.
Okay.
Okay,
So,
okay.
since which slide you was not able to see the.
Actually, sir, since we have started the session, only the cover page was saved.
Oh, ho, ho. So,
Yeah,
okay, once again, in just 2 minutes, I will revise. We have seen that
yeah,
CPI
yeah.
and GDP numbers.
Sure, sir. Sure, sir.
Thereafter,
Hmm.
GDP growth projection by IMF. We have seen that India is here. Then global commodity and food prices. We have seen. Thereafter, inflation numbers for advanced economies and emerging market economies. Thereafter, we have seen effect of inflation and supply. Thereafter, global financial market, and yes, most important, FI sectoral analysis. And this is the number 44 lakhs 21,000. This number I have already told that these are the shares held by FI. Thereafter, we have seen FDI statistics, their numbers and their investments. Thereafter, key changes in policy rates, e-way bill and toll collections. This we have seen. After, are these slides are visible to you right now?
Yes, sir. It is perfectly visible right now.
Okay. Then auto sector. Thereafter, hotel sector, trend in exports, trend in imports, GST monthly revenue, rail cargo, and right now we are at steel and production, steel consumption and production of the cements. Okay, so when we talk about steel production and steel consumption and cement production, it is worth noting that these these statistics you will be hinted at a capex is made. So infrastructure, real estate sector, and capex. These are the three sectors which likely to be affected by the steel consumption and cement production, and that's why I'm very much bullish on that the growth rate of the GDP will be higher because we have the highest spending on infrastructure as well as real estate. Then let's have a look at production linked incentive schemes announced in the union budget. In union budget of 2022, 2020, production linked incentive scheme was introduced, and in 2021-22, the amount of the capital outlay was announced at 1.97 lakh. That is around 2 lakhs crores. Okay. Now, why I am taking these 2021-22 figures, because their statistics, their actual implementation is right now available with us. When we look at the sector-wise allocation of these 2 lakh crores, in March 2023, initially three sectors, that is pharma ingredients, large-scale manufacturing, and medical devices, was introduced. Thereafter, 10 sectors were added in November 2020. And in September 2021, one sector, that is drone and drone component sector, was added here. So these are the sector added, and I have presented them on the timeline. However, when we consider these in the ascending order, you will see that large scale manufacturing is fetching around 20%, automobile and auto component is fetching around 12%, that is the allocation of 25,938 crores. Okay, thereafter medical devices and pharma drugs, telecom sectors, these are all in reducing order. But one thing one has to consider here is, what if these 2 lakh crores are being given by government? What will be the impact? These 2 lakhs are nothing but the incentive, and almost 20% incentive is given by, on average, is given by government. So it means that in order to get this 2 lakh crore, the business houses needs to invest 10 lakh crore. So just consider the 10 lakh crores needs to be invested in India it will give you huge capex, huge capex will be there. That's why we can see good demand in capital goods. But one more question arises here, that if out of those 10 lakh crores, if 2 lakh crores are given by government, what about remaining 8 lakh crores? Let's say if self contribution by promoters and FDI is coming up to 20% more, then what about 6 lakhs crores? So these 6 lakhs crores needs to be financed by the banks in India. And just imagine if these 6 lakh crores are financed by those banks, what will be the size of those balance sheets of those banks? That is the credit growth which is come here in picture, and which is mostly not considered by many people while investing. So this is this is the factor where we need to consider the credit growth. So here I have depicted one tabular format where credit growth since last 4 quarters is being given for public sector banks. So first is public sector bank. The credit growth is increased from 7.8% to 15.7%. For private sector bank, from 15% to 19 to 20%. Yes, for foreign banks, there is a reduction in credit growth from 13% to 9.6%. Regional rural banks from 9% to 12%, a good growth. And for small finance banks, there is a credit growth of 25% to 35%. So these credit growth are depicting that huge number of lendings are being given by banks, and that's why the size of banking is increasing beyond the phenomena. And that's why I will suggest you, as we have considered automobile sectors, already good allocation is given here by auto and auto components. 12%, that is 25,900, almost 26,000 crores incentives are being allocated to their sector. Secondly, one more important thing which we have to consider is that we are now become the third largest automobile manufacturer in the world. And it's important to know that automobile sectors incentives given by the government are just preliminary here. This may be increased, and they want India to be the topmost or the manufacturing hub for the automobiles. That's why my next sector, other than oil and gas and metal and minerals, the next sector I would bet is automobiles. Thereafter, as we have seen that we need to go for the capital expenditure of 10 lakhs crores, and the government is very much aggressive on that front. They are already giving PLI of 2 lakh crores. So therefore, total capital expenditure needs to be at 10 lakhs crores, and that's why I find that capital goods sector is one of the most important sector here, which one needs to be considered in upcoming 3 to 4 years. And as discussed, banking and financials, that the credit growth given due to this capital expenditure, there will be highest credit growth amongst the banks and financials. And that's why this is the third financials, this is third space or third sector which one need to focus on, along with the earlier discussed 2 sectors. So these 5 sectors, I find if our investment in these 5 sectors will be beating the normal market returns. Okay. Then I will have my concluding remarks that inflation is likely to top out globally. As we have already seen, the emerging market inflation is topping out, and I find some kind of relief will be there in developing markets also. The quantitative tightening may be slowed or halted globally, and rate reduction will be also started. US went to shrink its balance sheet, but the Chinese central bank, that is PBOC, is likely to expand its balance sheet, and therefore money flow will be there to emerging markets. Then after, we have already seen that China is now no more exporter of the deflation to the world. So inflationary situation will be here, but the optimum inflation rate and optimum interest rate will be there for the good market. US dollar likely to correct against the EM, and we have already seen that from 115 to 103 dollar index has been reduced. The capex cycle started will last for this decade. Definitely, as already we have discussed that the capex of 10 lakh crore, if not a small amount, even none of the budget has in India has projected that this much amount can be made as a capital investments here. So, with this concluding remarks, I would like to say, uh, I find we have seen good discussion here, and definitely to talk about the financial markets, it's not that easy. It's not that limited aspect. There are many other aspects also, but looking at the time constraint, we could not discuss it on those length. That's why I find this interaction may have given you some kind of inputs, and the statistics presented by me may be of your help. Let's have a concluding remark that I find looking at the optimum inflation rate achieved by India, the monetary policy decisions by RBI likely to halt here, the quantitative tightening likely to halt here, and that's why we may able to see a good kind of bull run. But right now, as from Nifty, we have Nifty and Sensex, we have seen the correction of 12%. I find there is a bull market is taking shape underneath this bear market, and that's why this is a good time to accumulate some quality stocks, and specifically the stocks related to sectors we have discussed so far. Thank you one, thank you all. Thank you Surbiji for your throughout the moderators. Thank you very much.
Thank you so much, sir, for sharing your wide perception and experiences. Thank you so much. And I would like to put some of the questions to Amitji.
Yes.
So there is one question. Monopolistic market, public sector monopolistic markets, private sector competitive markets, public sector competitive markets.
Hmm.
Which one is ideal situation for normal consumers?
Uh, Please again, can you repeat the
Yeah,
question?
yeah. Monopolistic market, public sector monopolistic markets,
Yes, sir.
private sector monopolistic markets, and public sector competitive markets and private sector competitive markets. Which one is the ideal situation for normal consumers?
Okay, if you are talking about the consumers, it's always a private competitive market will be beneficial to them. But if you're talking about the investor point of view, then it's a private monopolistic market which is much beneficial for them, because if monopoly is there, one can take good advantage of the profits, and that will add values to investors. But for here the question is asked for consumers. That's why I find that private competitive market will always be beneficial to consumers.
Okay, okay. So thank you, sir. We are getting some requests from the viewers that your presentation is really wanting, and if you could please share your presentation with all of us. So after the session, we can circulate it to viewers.
Sure, for
And
sure. I will
yeah,
share with you on email. You can share with
sure.
other. Definitely,
Okay, okay,
the PDF of these slides will be shared with you.
okay. Thank you so much, sir. Thank you. And now let's move forward for today's second technical session. Very interesting subject: alternate investment fund in India framework. And for this, we are having with us our eminent speaker, Sri Abhishek Raviji, partner at Ravi Rajan and Company LLP. He is qualified chartered accountant and has qualified BSc Honours International Business degree from Brunel University, London. His practice primarily focuses on for providing audit, transaction, and tax services to alternate investment funds. He has advised and assisted clients on structuring and successfully setting up alternative investment funds in India and offshore feeder structures. He also facilitates to resolve family disputes, execution of trust deeds, shareholders agreement, and structuring entities from family realignment, regulatory and tax perspectives. So without taking much of time, I request Abhishek ji to share his views and perception with all of us.
Good evening, everyone. I hope I'm audible.
Yes, sir, perfectly audible.
Okay. Thank you, Survi ma'am, for the kind introduction, and Mr. Amit ji for a brilliant presentation. At the outset, I would like to thank Sri Charanjot Singh Nanda sir and Kota Srinivasan sir for the opportunity to present our views and share our insights into financial sector and alternative investment funds.
Thank you.
So the purpose of the PPT is to understand about AIF in India and the regulatory framework. The first part of the presentation deals with understanding about AIFs. So let us start the presentation. I hope the table of content is visible and the slides are visible.
Yeah, perfectly.
Okay, sure. So we'll start the presentation now. So, before deep diving into what is an alternative investment fund and what is the structure, let us understand the rationale for existence of an AIF in India. So, today, these days, we see a lot of investment deals happening and investments into startups at growth stage, secondary market deals, etc. But back in the days, before the emergence of venture capitalists and private equity, entrepreneurs dependent on the financial institutions for lending, private placements, and IPOs. However, these are not optimal sources of raising funds. Thus, SEBI introduced venture capital regulations in 1996 with the aim of filling the gap between capital requirement and the fund availability for the growth companies. Subsequently, in the year 2012, SEBI overhauled all the regulatory aspects and introduced SEBI AIF Regulations 2012. The rationale for introducing AIF was to invest in startups, MSMEs, growth companies, and also provide investment strategies and create an ecosystem for investments and deployments, not only from the domestic investors, but the foreign investors as well. So basically, an AIF is a fund which is established, incorporated in India, and that is a private pooling vehicle which sources funds from both domestic investors and foreign investors. They have a predetermined investment policy to deploy their capital into the portfolio entity. These AIFs are established in form of trusts, companies, or LLPs. All these AIFs have to be mandatorily be registered with SEBI. They have to have a license, and thereupon they can start the process of collecting contribution and deploying in the portfolio entities. Presently, there are more than 900 AIFs in the market, and the capital commitment has been increasing to 63% from 2012 to 2022 onwards, CAGR rate. However, the global investment right now is around $4 trillion, and it has increased from $4 trillion to $10 trillion, and it is expected to increase to $17.2 trillion by the year 2025. So moving on. So when the AIF regulations came in 2012, the amount of capital committed to capital invested was just 1%. Now it is around 50%, which shows an exemplary growth of CAGR 63%, which I provided in the previous slide. As you can see from the figure, the total amount of capital commitment raised is around 6,95,000 crores. And out of which the funds raised is around 3,39,000 crores. And amount deployed is 3,11,000 crores. So these are the cumulative figures that are available for August 2022. But despite the growth rate, AIF is still a very niche industry. In comparison with US and Europe, India's share of AIF to mutual fund is just 7%. However, US and Europe is above 35% and 40% respectively. AIF is still considered a very expensive vehicle, and it is considered as high return, high risk investment category as of the moment by all the investors. So just to draw a comparison between India, US, and Europe, AIF right now has an investor limitation of 1,000 investors, and US only accredited investors are allowed. Accredited investors means that those investors who pass a specific threshold as per their income tax returns filed. Europe allows retail participation as well. Considering AIF is still a niche sector, the commission or the management fee is 2 to 3%, and whereas in US and Europe, it is 1 to 2%. In the last 5 years, AIF has grown more than the mutual fund industry. AIF has been growing at 52%, which shows there's a preferential diversified investment tool. So the under-penetrated market in AIF will keep growing, and it is expected to grow at 25% CAGR by 2025. This as an additional insight, even the government of India is working through an AIF model. I assume that we all remember during the COVID times, government of India launched a 50,000 crore package for the MSME. Out of that 50,000 crores, 40,000 crores came from the AIFs and 10,000 crores came from the government through State Bank of India venture capital funds. So government of India has also given its blessing to the AIF industry and recognizes as a platform to replace P and VC. So just to give more insights into AIF, right now there are 979 AIFs as on August 2022. So the growth of AIF factors down to SEBI making the online filing application easier. The process has become transparent for the investor. There has been simplification of AIF taxation, both by the Finance Ministry and the income tax. However, commissions charged by the AIF is still very high as of the moment. Moving on to the next slide. Some of the salient features that drive an AIF growth is diversification of the portfolio. And not only does it give access to stock markets, but it gives access to angel startups, unlisted debt, unlisted equity. So there's pool of options available to an investor, and diversification is one of the key rationale for AIF becoming a preferential vehicle. So just to go back into history, since AIF started in 2012, between 2012 to 2015, there were just a few minor amendments and notifications. Post 2015 onwards, there was one notification every year for the AIF industry. In the last 4 months, there has been 3 notifications for the AIF industry, 6 circulars, and 4 study papers for the AIF industry. This shows that SEBI has started becoming stricter with the AIFs as new players have started entering the market due to the increased demand of this vehicle. This has led to additional compliances that has driven the cost of AIF substantially, and these costs are essentially loaded onto the investors. So it has become critical for the regulatory bodies to simplify the process to maintain the existing cost structure as well as a recommendatory aspect. So some of the reforms are widening the scope for investment for Indian funds. So AIFs allow investment in MSMEs, they allow liquidation finance, companies that are under IBC. So investment in stress asset has been allowed as a category 1. There has been a lot of transparency for the investors to track their returns and to claim all the tax exemptions. Additionally, GIFT City has been one of the flag bearers for a pooling investment for offshore feeder fund. IFSC is competing with Mauritius, feeder structures, Dubai, Abu Dhabi, Singapore, Cayman Islands, Netherlands. So India, the rationale for having Gujarat GIFT City IFSC is to have a worldwide competition for AIS. Additionally, there is no requirement of PAN for the foreign investors in IFSC. Further, the definition of the venture capital fund also has been exhaustive. Moving on to the next slide. So let us understand the structure of an AIF, how an AIF looks like. So essentially, we will deep dive into all these concepts, but there is an investor who will invest into the fund, and then the fund will invest into the portfolio entities. The portfolio entities will make a return. The return can be in form of interest, capital gains, dividends, etc. Then it will be given back to the investment fund, and the investment fund will pass it back to the investors. Broadly, this is the AI structure. We will get into all the parties that are involved in the later slides. Moving on. So before we open any fund or any investment vehicle, so we have to consider a few aspects. तो जब भी हम कुछ इन्वेस्टमेंट फंड स्टार्ट करते हैं तो हमें पता होना चाहिए कि हमारा सोर्स ऑफ कैपिटल कहाँ से आएगा. डू वी हैव कंट्रीब्यूटर्स, इन्वेस्टर्स टू पुट इनटू दैट इन्वेस्टमेंट व्हीकल. और ये भी जरूरी है कि हमें ये पता होना चाहिए कहाँ पर हमारा पोर्टफोलियो एंटिटी है, कहाँ पर अपॉर्चुनिटी है. क्या वो अपॉर्चुनिटी हमें सब्सटैंशियल रिटर्न देगा टू मीट आवर कॉस्ट एंड एक्सपेंसेस टू ओपन द स्ट्रक्चर. देयर शुड बी अ स्ट्रॉन्ग मैनेजमेंट टीम to ensure that we make the returns. There should be operational flexibility and administrative overheads नहीं होने चाहिए हमारे पास. दूसरा चीज जो है important, tax. It should be important that all the tax regulations, laws are considered before opening the AIF and also choosing the jurisdiction. हमें DTAA agreements, tax treaties को भी पढ़ना पड़ता है to ensure that it is beneficial for the end investor. So these are the structuring considerations. Before opening an AIF, I have to have all this in pen and paper. There should be a proper blueprint. Without addressing all these points, it won't be beneficial for the investor or for the fund to be successful. So essentially, there are 3 categories of AIFs which have been listed by SEBI. This is as per the definition of by SEBI Regulations 2012, which keeps getting amended. So category 1 invest in startup, venture capital funds, angel funds, infrastructure funds, social welfare funds. Additionally, recently SEBI has come out with an extensive definition of category 1, which allows to invest in special situation funds, which is the companies that have gone into liquidation and are under are resolution applicant under the Insolvency Bankruptcy Code 2016. This field is growing at a very fast pace and is supposed to be the future. Thus, keeping that in mind, SEBI has introduced a new category of fund in category 1 itself. Before I come to category 2, let me define what is category 3. Category 3 is what we say is hedge funds, derivatives, long short options, IPOs, and listed markets. And category 2 is something that is not category 1 and category 3, meaning thereby it is unlisted debt and unlisted equity. They also allow to invest in real estate markets. So moving to the next slide, let us understand all the growth factors and the key differences of these categories. Category 2 has been growing at a 55% CAGR per year. Category, the rationale for the same, which will be highlighted in the next slides, is that the compliance is very moderate and it's a very open-ended definition given by SEBI. Thus, most of the fund managers prefer to have a category 2 fund. So let us understand the differences in detail. So as earlier stated, the definitions of all the categories have been mentioned. Category 1 is into startups, SMEs, MSMEs, angel funds. Category 2 is something that is not category 1 and 2, that is unlisted debt, unlisted equity. Category 3 is hedge funds, complex trading strategies funds. So a minimum investment by investor is rupees 1 crore for each of the fund. So as a contributor, I have to put minimum 1 CR to be eligible to become a contributor in the fund. Category 1 and category 2, since they both are unlisted, they are closed-ended funds. And category 3, since being listed, they are open-ended funds. Now let us understand what is sponsor and what is the sponsor commitment. Sponsor, what we say is the nomenclature derives from, it's a promoter, essentially. Sponsor is one of the most important participants or the investor in the fund. They put the initial capital. They give confidence to other investors to deploy into the fund also. Example, if Rakesh Jhunjhunwala invests in a company, we all get amped up to invest in the same company. So therefore, the sponsor should have a lot of credential, market credibility and credentials and a good track record. So essentially, अगर देखा जाए तो अगर मेरा फंड का टोटल कॉर्पस 100 करोड़ है तो स्पॉन्सर को मिनिमम 2.5 CR 2.5% और 5 करोड़ डालना पड़ेगा फंड में. That is, minimum he has to put, if the fund size is 100 CR, he has to put 2.5 CR into the fund. This is same for category 1 and category 2. However, for category 3, the same percentage differs. So for category 3, if the fund size is 100 CR, so I have to put as a sponsor 5% of 100 CR, 5 crores or 10 crores, whichever is lower, to start the fund. And additionally, one more point, for angel funds, the amount is 50 lakhs or 2.5%, whichever is lower. जब AIF पोर्टफोलियो एंटिटीज में डालता है वो 100% नहीं डाल सकता. उसका टॉप सीलिंग, उसका सीलिंग लिमिट है 25%. अगर 100 करोड़ का फंड है, मैं सिर्फ 25 करोड़ एक पोर्टफोलियो एंटिटी में डाल सकता हूं. और कैटेगरी 3 में वो 10% हो जाता है, दैट इज 10 करोड़. ये रैशनल, द रीजन फॉर दिस इज इट शुड नॉट बी एज इफ देयर इज अ कोल्यूजन बिटवीन द AIF and the portfolio entities. So from that perspective, SEBI has put a cap. But as an additional point, if I open a AIF in the International Financial Service Center in Gujarat Gift City, I can put 100% of my capital into one company. That is, I can put 100% in a single portfolio entity. So there are a lot of perceived advantages of having a opening an AIF in Gujarat Gift City. So moving on, leverage. Leverage means basically if I can borrow or not. So AIFs cannot borrow funds except for meeting the cash flow, and that too should be payable within 30 days. However, The same does not apply to category 3, where leverage is allowed up to 2 times. As mentioned earlier, I can invest in unlisted companies in category 1 and 2. However, in category 3, it should be only listed securities. You can see over here that primarily in unlisted company and 49% can be done in listed securities. This listed security is marketable debt, essentially, not a listed equity. In regards to the disclosures to SEBI and the investors, category 1 and 2, it has to be done a quarterly disclosure. Whereas for category 3, it's a monthly disclosure. The rationale for the same is, since the NAV of category 1 and 2 is difficult to track on daily basis, so the disclosure is quarterly. However, for category 3, there's a daily NAV movement, so the monthly compliances have to be done by the fund manager. AIFs also can get themselves listed on a stock exchange. However, the same has not happened in India as of the moment, and the amount, the denomination in terms of listing is they have to have 1 crore units to list. In regards to the compliances and restrictions, a category 1 has a moderate compliance and restriction framework. Category 2 is extremely low. That's why there's a 55% CAGR growth. Category 3 is extremely high as they invest in the liquid listed market, and they have to be accountable to a lot of entities, SEBI and SEBI takeover panel, SEBI takeover code, etc. So essentially, I have captured all the key differences in these 2 tables. Now, let us move on to the next slide. So, as I've said earlier, the AIFs are usually set in form of LLP, a limited liability partnership, company, or a trust. However, most of the AIFs are set in a form of trust. The rationale for the same is there is extreme confidentiality and discreteness maintained for the investors. There's ease of operation. There is less statutory compliances, and there is tax transparency as well. Earlier, when the regulations had commenced in 2012, most of the AIFs were setting up as LLP, which was operationally ineffective, and there was a lot of administrative overhead on them. So trust gives a perceived advantage. So from that perspective, all the AIFs that are getting set are in form of trust only. So the trust is governed, just as an additional information, the trust is governed by the Indian Trust Act 1882, and all the rules and laws, regulations for those are applicable on the fund and the trust as well. We will also understand the key documents that are required in detail as well in the upcoming slides. But before that, let us move on to the next slide. Let us understand the regulatory framework. So, I had shown a diagram previously, and I will now deep dive into the same concepts. Kindly take a minute to just go through the diagram, and I will explain the same. So, the investor basically puts into the fund puts into the portfolio entities, and the portfolio entity will return the money back to the fund, and the fund will return the distribution back to the investor. Now, let us understand the nitty-gritties of it. The investor will put capital. Against that, they'll have to sign a contribution agreement. The fund will put into the portfolio entity. Against that, there will be a shareholder agreement signed, or a share subscription agreement, or a share purchase agreement to be signed. So, as mentioned, we have a promoter, that is the sponsor, who is one of the most important person in the fund. So sponsor will put a sponsor commitment that is 2.5% of 5 CR, whichever is lower for category 1 and 2. And for category 3, it will be 5% or 10 CR, whichever is lower. So against that, the sponsor will get a contribution agreement. These contribution agreements are a tripartite agreement, which will get it signed between the fund, the investor manager, and the trustee. So now let us come to the investor manager. All the deployment or calling the contribution, basically first I'll draw down that capital from the investor. The investor manager will make that decision. How to call the capital, what are the tranches, whether it will be on milestone basis or a one lump sum payment. And then the deployment strategy will also be designed by the investor manager. And additionally, the investor manager will decide when to redeem the investment from the portfolio entity and distribute it to the investors. For all these aspects, the investor manager charges a commission, which in India is 2 to 3%, and which is termed as management fees. So all these charges are provided in the document and are inked and stamped by all the parties, approved by SEBI as well. So investor manager is the overarching body responsible for the operation, administration, and the management of the alternative investment fund. So also, there is investor manager promises you a hurdle rate. A hurdle rate is a minimum rate of return that the manager will promise to the investor. Example, if the hurdle rate is 10%, for the fund to be successful, investor manager has to make minimum 10% per year on CAGR basis at the end of the lifetime to compensate the investor and the fund to be successful. Any amount over and top of the hurdle rate, the investor will get carry units. So, example, if the total IRR is 15% and the hurdle rate is 10%, at the 5% made over the hurdle rate, they can split between the investor manager and the investor in a ratio of 90-10 or 80-20, whichever both decide. So this keeps the motivation of the investor manager high as well as gives additional alpha returns to the investor. As I stated earlier, AIF is a highly risky product and it's high risk, high return product. So usually we've seen in the market IRR of 20-25%, even 63%. Moving on. One of the most important aspects to understand before we start an AIF. This is the timeline of the fund. So from the fund setup, it takes 3 to 6 months to get the SEBI registration done. This is a very tedious task, and there's a lot of back and forth with the SEBI officials for them to accept our fund terms and the investment objectives. So in regard to this, it takes 3 to 6 months to set up the fund. Once SEBI gives us the license, there's a period of 12 months that commences. 12 months from the SEBI registration after the end of that period will be the first close. First close is one of the most important timelines in the fund. So essentially, in the first close, the hurdle rate starts. The promise of 10% starts. From here, the investor manager has to make 10%. So it becomes imperative for the investor to collect the contribution amount from the investor and start deploying in the portfolio entity during this period after the first close. The first close to the final close is the last date on which I can collect money from the investors. So there's a term called final close and a commitment period, which can be intermingled. So assume in this example, I've taken a life cycle of 5 years. So the fund will start from the first close, 5 years will start, and I can also apply for two extensions of 1 year each. For applying for extensions of 1 year each, I need to take 75% majority voting of all the investors. Only only after that, I can apply for these extensions. Further, in November 17, 2022, SEBI had given a circular stating that the first close will be restricted to 12 months. Earlier, there was no timeline of the first close. It used to be, usually the industry standards were around 18 to 24 months, but now it has been restricted because SEBI wants the funds to start and the investor manager to pool that money to deploy into the fund and the portfolio entities. As I've said, SEBI has started getting very strict and the scrutiny is increasing month by month. So AIF, though there is no doubt about AIF to grow, but additional compliances will also keep growing. Moving on to the next slide. So the parties to the AIF that we have covered in the diagrams. So just to again brief into it, the investor will give an commitment letter essentially to the fund, and the investor manager will draw down to that commitment letter and give a contribution agreement. The fund is independent body of an investor manager. Usually there's a third party trusteeship service who help to operate the fund, but in essence, every aspect is overseen by the investor manager along with the trusteeship company. So the inflow and outflow is decided by the investor manager, but so that the investor manager and the fund are independent and at arm's length, there is a third party trusteeship services that are obtained for setting up the trust vehicle. That is the fund itself. Usually in the market, there is a different auditor for a investor manager entity and a different auditor for a fund. Let us move on to the next slide. Investor manager. Investor manager has to fulfill the SEBI qualification requirement. Usually investor manager are not only, they may be a person, and usually they are set up as an LLP, private limited bodies. In the market, mostly I've seen LLPs. The investor manager, the fund manager, has to have minimum 5 years of experience in the capital market sector. This is a mandatory requirement. Otherwise, the fund license will not be provided by SEBI. This is one of the most red flagged area that SEBI also asked during their Q&A with the fund. So investor manager is responsible for the administration, operation, all the strategies from drawing down the capital, investment and disinvestment of the AIF. So investor manager are required to act in a fiduciary capacity towards the investor of AIF. They're responsible to the investors that they get their principal back as well as the hurdle rate. In a lot of cases, the investor manager may be a sponsor as well. The entity might be the same. If the investor manager has a good track record, then usually they are second-time fund managers or third-time fund managers. They merge it and become sponsors to the fund as well, in the same entity or in a different entity with a different percentages. Let us move to the next one. Sponsor. So sponsor is a person who has to have the credibility and a track record. And as stated earlier, there are a minimum continuing capital commitment requirement for the sponsor to be in the fund. We will also understand in detail if a sponsor is a foreign-owned fund or a foreign-owned person, then what is the impact on the fund itself? which we will cover in the later slides. So to sum up the transactions and how the mechanism works is I raise funds. The fund will raise funds from the investors, and the investor manager entity, the employees of the investor manager entity can put, instead of putting 1 CR cap, they can put a minimum of 25 lakhs to also become investors in the fund. This is a special allowance given by SEBI to the investor manager, employees, and directors. Upon raising funds from the investors, the fund will issue units, and there are different class of units. So essentially, there'll be a different category class of units depending upon whether it's an Indian investor, it's a foreign investor, whether they are sponsors or they are the employees of the investor manager. There are a lot of subclass of units also. Each subclass of units will have a different term and condition. Thus it becomes crucial and important for the fund to keep a track of whether the fund is in form of Indian rupees, dollar denominated, and considering the return percentage are different for each class of investors, they have to ensure proper bookkeeping and record keeping so that the ultimate distribution is fair and equitable as per their contribution percentages. So to sum up, this is the entire process from a macro perspective, bird's eye view, how the fund flow movement happens from investor to fund to portfolio and back to the investor. Let us move on. Let us understand the key document requirements and the service providers to an AIF. So basically, these are mandatory SEBI required documents to be submitted. Oh, am I audible? Am I audible?
Yeah, now it's fine.
Yeah.
Yeah.
Okay. Did I miss any part? How long I've been on mute so that I can?
It's fine, sir. You can go ahead.
Okay. Great.
Yeah.
So some of the primary documents that are required by SEBI are investor manager agreement, which is signed by the trustee and the investor manager. The trust deed, which is signed by the settlor and the trustee. The trust deed is important to open the trust and it helps to form the trust. There's a private placement memorandum. This is the Bible. This is the constitutional document that governs the entire AIF. In this document, I will have all the key terms and conditions that govern the AIF. So I will have my entire key investment management team, the track record, their entire details, qualifications. I will have the structure of the AIF. What are the conflict of interest? I will cover the hurdle rate. What is the waterfall distribution between the investor manager and the investor? I will understand the legal and the current legal and regulatory impact and update the PPM year on year. Further, tax aspects are also covered in this document. For every aspect, for considering the PPM, the private placement memorandum is the crucial document. This is the go-to document for any query or clarification that needs to be resolved. Then there's a contribution agreement. This is a tripartite agreement. Any flow of money is governed by this agreement, which is signed between the contributor, the investor manager, and the trust. And of course, there's a LLP agreement. जो भी हमारा इन्वेस्टर मैनेजर बनता है, तो उसके जो पार्टनर्स हैं, they sign a LLP agreement amongst themselves where they define the key terms and conditions. Kindly go through this document and we'll get back in a minute. Now, let us move. So, we require a lot of service providers to start an AIF and to continue the operations. One is the trusteeship service that are required to help to open the trust. Then we require the lawyers to draft all the above documents mentioned, that is the investor manager agreement, the trust deed, the private placement memorandum, the LLP agreements, and the contribution agreement as well. All these documents are captured into one deck and along with a Form A submitted on the online portal to SEBI for the application for the fund. Then there are a lot of compliance service providers as well who help to do the running around and examine the jurisdictions from a tax and operational perspective for the fund manager. Prior to November 2021, all the PPM used to go directly to SEBI. However, in November 21, SEBI issued a notification that the PPM has to, the modalities of filing has to go through the merchant banker first. So SEBI, instead of doing all the due diligence on the fund manager, has outsourced the same to the merchant banker. For this has ensured that there is a dual check by SEBI. One is at their end and one is to the merchant banker on the EIS. However, the cost of merchant banker gets loaded onto the investor as a setup cost. There are auditors and legal professionals required. So there is audit of the fund, of the investor manager, of the sponsor entity, and additionally, there's audit of the private placement memorandum. If there is any change, even a minor one, in the private placement memorandum, the same is subject to a PPM audit year on year, and the same has to be submitted by 30th September to SEBI. So to value the NAV the AIF has put across into the portfolio entities, an independent valuer is also required. For category 1 and 2, the valuation exercise has to be done 2 times in a year, but for category 3, it becomes mandatory to do it on a monthly basis. So custodian services are required who help to ensure that all the units, if they are dematerialized, are maintained. They are like the depository participants. So as of the moment, only a AIF where total corpus is about 500 crores requires a custodian. Below that, there is no requirement. Whenever we purchase units of a portfolio entity, there is stamp duty charges. So we require the services of a share transfer agent as well. So that is also one of the costs that the AIF bears. And of course, one of the most important operational person is the fund accountant. If these transactions are not kept in record and legally vetted day in, day out, along with the compliance calendar and changes, then it becomes an administrative overhead, and AIF faces operational difficulties to manage their books of accounts and pay taxes on behalf of the investors, or do any withholding or pay any withholding taxes. So the fund accountant job is the most important in this, and either the same is maintained in Excel or in a lot of high-end softwares, which is valued and transacted on a daily basis. Service providers are essential to the functioning of a AIF, and without them rendering the services, an AIF cannot function smoothly and can face a lot of litigation and tax losses as well. So moving on to the next slide. Foreign investments. So this is a very important slide. If an investor from foreign invests into the AIF, if the total corpus is 100 crores, even if the foreigner invests 100 crores into the AIF, into the domestic AIF, the domestic AIF does not become a foreign, it will not become a foreign owned investor. And this has been clarified by the Finance Ministry and RBI as well. So foreign investors usually come through automatic route, and thus meaning thereby without any government approval. So if there's 100% foreign investors also, the downstream investment into the portfolio entity does not become foreign owned. However, in some cases, an AIF which is in India becomes foreign owned if the investor manager or the sponsor entity are non-residents, meaning thereby if the investor manager is set up as a private limited and more than 50% shares of that private limited is owned by foreigners, then the investor manager becomes a foreign owned entity, also meaning the fund becomes a foreign owned entity, thereby any downstream investment into the portfolio entity will also become foreign owned. So thus, which will increase my compliance cost. Any investment, the portfolio entity will also have to accept the money coming into their books from the AIF as a foreign source, and they'll have to follow and comply with all the RBI and FEMA regulations. So thus, it becomes important to check the residency status of all the individuals who are in the investor manager and the sponsor entity. Once an AIF is rendered as a foreign investor, then there's a restriction on the instruments, sectoral caps, pricing guidelines, and conditionalities mentioned by SEBI. Let us understand this further. So, if I want to brief this, can an AIF accept foreign investment? Yes, it can accept 100% foreign investment through automatic route. And if the foreign investor manager is owned and controlled by Indian citizens, then the AIF is supposed to be considered a domestic fund. Thereby, the investment into the portfolio, downstream investment into the portfolio entity will also be considered to be domestic, and no RBI FEMA guidelines have to be followed. However, if the investor manager and the sponsor entity individuals are non-resident, which is an entity in which 50% or more of equity is held by a person outside India, or in an LLP, more than 50% of contribution comes from a non-resident Indian, then the AIF will also become a foreign owned AIF, thereby meaning downstream investment will also become of FDI into India. So this is one of the key aspects to verify before proceeding with the percentage in the investor manager vehicles. So, if a fund is Indian owned vehicle, some of the compliances that are provided for Indian owned, there's a key differentiating between Indian owned and foreign owned. So an Indian owned has to just periodically give reports to investors and SEBI. However, a foreign owned investor, AIF, will, for every aspect, they'll have to report to RBI and FEMA along with SEBI. So the compliance cost increases, meaning thereby these compliance costs are burdened to the investor as an operational expense, and the return of AIS also goes down by a percentage or two. So let us move on to the next slide. Tax considerations. So before going through the entire process, let me explain how the tax works. The fund, AIF, is essentially a pass-through vehicle. The same has been provided by the Finance Act 2015, read with Section 115 UB, 1023 FB, 1023 FBA, and FBC. Thereby meaning pass-through vehicle means as if the investor has directly put into the portfolio entity. अगर investor directly portfolio entity में डालता है और portfolio entity वापस investor को देता है, तो tax जो डायरेक्टली इन्वेस्टर के हाथों में ही लगेगा, AIF के हाथों में नहीं आएगा. AIF सिर्फ एक ही काम करेगा, वो है withholding taxes पे करेगा. It will hold as per the instrument, it will hold a 10% withholding tax for domestic investors. So the fund जैसी portfolio entity देता है, we should ignore the fund and take the taxation in account of the investor. Fund will file some forms called 64C, 64D, so that the investor can get the TDS benefits, and the fund gives that observation of the amount that needs to be passed on to the investor, just from a compliance perspective. However, for domestic investor, the tax withholding will be 10%, and they will be, depending on the instrument, if it is interest, the investor will be, it will appear under the head of income under other sources. If it is capital gain, then it will be under capital gain. For offshore fund, the withholding taxes are, the TDS is as per the tax treaty rates. So example, अगर offshore fund, अगर Mauritius में है, I will have to check the DTAA as a tax treaty benefit between India and Mauritius and see whichever is more beneficial as per Section 90 to claim the tax benefits. And उसके अनुसार हमारा TDS fund काटेगा और investor को pass on करेगा as a credit. So some of the rates that are applicable on a higher side to the foreign investors on dividend is 20%, interest 40%, and capital gain, it can be 10% or 40% to foreign investors. It depends again on the tax treaty, permanent establishment, factors like POEM, etc. This pass-through status is only for category 1 and 2. The same is not applicable to category 3. So, thereby meaning, coming to the previous slide, category 3 is not considered to be a pass-through. So, category, any amount coming back to the fund, they will be charged at the maximum marginal rate at a business or at a business income. So, tax for category 3 becomes very ineffective and leads to higher taxation for the fund as well as the investor. For category 1 and 2, it will depend on the individual's tax status. So CBDT has come out with a lot of circulars, again year on year, to define how the taxation has to be done and complied with for the fund as well as for the investor. Now, let us understand the tax for the investor manager. Since investor manager हमारा services देता है fund को, जो भी 2% है, and उसको additional carry units मिलते हैं to make the extra profit, उस पे भी tax होता है. तो that tax is at 30% again. Again, there's a dual position right now being taken that any capital gain on the carry units should be taxed at the capital gain percentage to the investor manager, but not at the business income of 30%. But this is still under consideration, and we are awaiting for a specific guideline on this. So these are some of the annexures also, which is these are SEBI data that have come as on June 2022, which are yet to be updated, which shows how the AIF commitments have raised, and we will cover that through Q&A as well. So I'd like to conclude the presentation with just a small quote: "An investment in knowledge always pays the best interest." It's a quote by Benjamin Franklin. So it's important to gather that knowledge also, so that we keep making the alpha returns. Thank you for everyone's time, and thank you for listening. And I'm open to any question and answers as well.
Yeah. So thank you so much for contributing to our knowledge basis. It was a very engaging session, and we are receiving very overwhelming response from the listeners for both of the sessions. So thank you to both of the speakers. And now I would like to start question and answers session. We have some of the questions with us. Yeah. So this is one for AIF, I guess. Can high net worth investors, HNIs, invest in companies such as Adani and Reliance using this special purpose vehicle?
Correct. So actually, they cannot invest in because the AIFs, the fund manager will decide where they want to deploy that money. So it might not be necessary that these special purpose vehicle mandatory deploy in Adani or Reliance.
Okay. Okay. Yeah. Taxation of AIF set up in GIFT City.
Correct. So GIFT City has a lot of predominantly has given a lot of advantages in terms of there's a 10-year tax holiday for gifts in the GIFT City. There is no GST requirement also as of the moment, and taxation again for category 1 and 2 is very liberal. However, for category 3 it is still lower than what we are seeing, but the pass-through status for category 3 has not been provided even in GIFT City.
Okay. Okay. So there is one more question. What is the difference between in role of trustee, custodian, merchant banker? Is there any overlap of responsibilities?
Absolutely. Let me also take you all to that slide. Yes. So trustee is basically an essential player, and trustee is a third party who will just manage that fund on behalf of the investor manager. The investor manager will make that decision. Trustee is just an authority on whose name the fund will keep functioning, and they provide the trust vehicle and help to open the bank account. And through a trust deed, they delegate all the powers of the trust to the investor manager to make all the decisions. This is the first aspect. Now let us understand merchant banker. Merchant banker comes at only at two parts. One is to file the SEBI application and do the due diligence on the whether the key fund terms are as per the SEBI regulations and the investor manager meets the 5 years SEBI qualification criteria. Further, every 1 year, the valuation also has to be done, and PPM changes have to be done. Thereby, merchant banker may provide the services as well. And in regards to custodian, a custodian will be only appointed. Custodian is a person, just like we have dematerialized shares for listed market, these services are provided by CDSL and SDL. Similarly, custodian provides the services for maintenance and upkeep of these dematerialized units for the AIS on behalf of the fund manager. So, and a requirement of custodian is only required when the corpus is above 500 CI. So essentially, there is no overlap. Yes, but these all parties keep communicating with each other to ensure smoothness of operation.
Yeah. Okay. So, as you have already discussed the concept of foreign owned,
Yes.
right? So there is one technical question in this. Can a foreign body corporate be AIF?
Correct. Yes. So just to also give an example, a foreign body corporate can also be an AIF. And Gujarat Gift City, all AIFs set in Gujarat Gift City are actually foreign owned. So because Gujarat Gift City is considered as a special economic zone, and thus thereby meaning they are competing with all the international players. So even if I set up an AIF in Mumbai and an AIF in Gift City, the AIF in Mumbai will be considered domestic, and AIF in Gift City will be considered a foreign owned. So all the compliances that have to be done for a foreign AIF will also have to be done for an IFSC unit also. Additionally, to answer your question, a foreign owned investor can also invest into India. However, they have to take approvals. It's under automatic route, but they have to file a lot of RBI form and ensure all the FEMA compliances have been are ensured.
Okay. Okay. Thank you. Okay. So there is one more question. For a AIF fund size, say a rupee of 200 CR, what is the ballpark cost of setting up the AIF?
So it depends on the cost of the service providers. Roughly, I would say nothing less than 60 to 75 lakhs as a setup cost only. But that usually, in my experience, has gone to 80 lakhs to 1 CR also.
Can AIF invest in already listed companies?
Yes. Yes, absolutely. In fact, AIFs too can participate in IPOs as well.
Okay. Career opportunities for fresher CAs in AIF.
Yeah, so Government of India has given its basically even wants to function through AIF route. Just to give you a small example, in this budget, there was an angel tax, section 56(2), that had come for foreign investors to put in Indian private limited owned bodies. However, the same was not applicable for AIF category 1 and 2. So Government of India also wants to work through this model and ensure SEBI is the governing body. So there is a lot of potential to be in this space and be any of the service providers or be in the transaction advisory.
Yeah. Okay. One more. Can an AIF launch scheme?
Yes, AIF can launch multiple schemes. So first AIF, I can have a debt fund. The second, I can have an equity fund. Third, I can have a category 1 special situation fund also. So AIF can launch multiple schemes.
Okay. Okay. So do we need to apply for PAN for each scheme of the AIF or only for the trust company?
So AIF, they have to apply for PAN for each scheme of the AIF, because there is a trust and there is a fund also. So a fund will be predominantly be different to the first scheme. So there'll be separate compliances for that.
Okay. Okay. Thank you so much. So again, multiple responses from the audience that PPT is very much demanded. So
Okay.
if you can share with us,
Thank you.
so we will circulate among audience as well.
Sure. Thank you.
So I'm just concluding the session right now. So due to some reasons, CA Kotha Srinivas sir, Vice Chairman Committee on Financial Markets and Investor Protection ICI, has not joined us. So on behalf of Committee on Financial Markets and Investor Protection ICI, I would like to thank all the eminent speakers, Abhishek ji and Amit ji, for devoting their precious time and to enlighten our knowledge banks. Thank you so much. All the members in the audience for being with us throughout the session. Thanks to Managing Committee Chairman Sri Charanjot Singh Nanda sir, Vice Chairman sir, and rest of the team members for organizing such webinars. Thank you so much. Thank you.
Thank you, everyone. Thank you,
Thank you.
ma'am. Thank you.
Thank you, Abhishek ji. Thank you very much.
Thank you.